Shares rally as markets bet on extra sluggish price hikes. Singapore Asian stocks took their cue on Friday from a past-due rally on Wall Street, as markets targeted on a possible slowdown inside the tempo of price hikes instead of a U.S. recession after records confirmed its economy shrinking for a 2D instantly quarter. MSCI's broadest index of Asia-Pacific shares outside Japan rose 0.41%. Japan's Nikkei proportion common opened up 0.36%, even as the Seoul index and Australia's index opened up 0.75% and 0.76% respectively. Economists are debating whether or not the arena's largest economy is already in or at the verge of a recession, because it battles its highest inflation in many years and gross domestic product shrinks at a 0.9% annualized charge closing sector, after a 1.6% contraction inside the zone before that. The Federal Reserve brought every other competitive hobby rate hike of 75 basis factors this week, its third this year. Meanwhile, China, still in the throes of COVID-19 outbreaks and lockdowns, did now not point out its full-year GDP boom goal after a high-level Communist Party meeting and said alternatively it's going to strive tough to acquire the fine possible effects for the economic system this year. U.S. equities, however, rallied this week as remarks through Federal Reserve Chair Jerome Powell brought about speculation that charge hikes could start out to slow and finally flip to price cuts in 2023. Shares of Amazon, Nasdaq, AMZN, and Apple, Nasdaq, AAPL, shot up 12% and 3% each after hours after the tech giants stated income that beat expectations. The Dow Jones Industrial Average rose 332.04 points, or 1.03%, to 32,529.63. The S&P 500 gained 48.82 points, or 1.21%, to 4,072.43, and the Nasdaq Composite introduced 130.17 points, or 1.08%, to 12,162.59. But analysts warned the rally may be short-lived. Financial markets have taken the combination of the Fed announcement and the terrible U.S. GDP print as affirmation that policymakers will ease off their competitive monetary tightening cycle before too long. Our sense, however, is that such hopes are untimely and that a number of this year's dominant tendencies, extensively the rise of the U.S. dollar, will reassert themselves before too lengthy. Capital Economics mentioned in Observe. The greenback stayed close to a 6-week low in opposition to the yen for comparable reasons, trading at 134 yen and 39 sen, bouncing 0.13% after an in a single-day plunge of 1.74%, the most given that March 2020. It touched a low of 134.2 on Thursday, the weakest for the reason that June 17. U.S. Treasuries slipped at the weak monetary information, with the yield on benchmark 10-year Treasury notes taking flight to 2.6759%. The 2-year Observe's yield, which usually moves in step with interest rate expectancies, changed into at 2.8703%. There's this seesaw in the intervening time with inflation and boom worries, mentioned Tom Nash, fixed earnings portfolio manager at UBS Asset Management in Sydney, with fantastically smooth U.S. growth figures putting the point of interest at the latter. When it is inflation issues, yields are going up; when it's growth concerns, yields are going down. What we're seeing at the moment is the marketplace is putting much less emphasis on inflation and greater on growth. Brent crude futures rose 0.8% to $108 a barrel, and U.S. West Texas Intermediate crude, WTI, changed into up 1.08% at $97.46. To examine markets and finance news, click at the State of Play of Asian Inventory Markets. Please click on